Oh, you want me to
Right.
start?
Yeah,
Okay.
go ahead.
I thought you open, I start. Okay. I'm taking off my mortgage guy hat. I'm putting on my investor hat today. So I appreciate you for playing ball with me, Mike, because like we chatted about offline, um, I'm likely going to look for, analyze, and purchase something in the 8 to 20 unit range over the next 12 months. I've done single family, I've done duplex, I've done fourplex. I lend on these as a mortgage broker. So not only my personal stuff, but in my business, I see a lot of it. I know how to analyze it, I know how it's, valued, all that stuff. You start talking about commercial, not well versed on the lending. I'm not as well versed on, how we get to certain cap rates and what I should look for at different markets. So I said, let's have a coaching session, Mike. I
Yeah.
appreciate you helping me out here.
Yeah. So I think residential investors, which I'll lump you in, wanting to go to commercial is, that's a leap because it's all new, right? The how you value the properties are new, expenses are new. Like you don't have lawn and water expenses in a house, but you will, and turnover's higher. Um, you're a counselor a lot more. That's one of the big things I remember getting to my first 5 unit building because they're all close together, right? So it's like their music is too loud. Their baby's crying, all of these things. So it is a different game. I do want to say two things. First, I am also looking to buy our biggest building. So for Olivia and I, that will probably be 20 to 50 units in the next year or two. So we are thinking alike. I do also want to caution this. Bigger is not always better. There is obviously a mantra out there. If you're not buying 40 units or more, you're a loser, and all of that stuff. I don't think that's true. I think most people could be wildly better off getting 4 single family homes. So again, you don't have to go here. It is a different animal with different expenses, with different stress, with different operational challenges. That said, I've also been very clear that I think most of the pain is coming to commercial, and it's because of the debt. There's debt being reset all the time that forces a decision. You're going to hear people talk about cash in refis, right? I bought a building, an 8 unit building. My bank doesn't want to refi unless I bring 50K to the table. That's called a cash in refi, right? They're going to lower the LTV, the cap rate. It's just going to be a mess. And some things are going to happen. Sellers or owners will be forced to sell. They don't have the cash in money. They're done. They're tired, whatever it is. So I think there's going to be some deals, and there will be some foreclosures. We're already seeing some massive foreclosures out there. The Texas one, there was one in New York the other day. These are just starting. So I guess the first thing I would tell you, because you're comfortable with numbers, is go get comfortable with cap rate. Go understand NOI, go understand, how you get to cap rates. The important thing to understand today is cap rates are going up and up significantly, right? Cap rates got compressed to sub 4% in many markets. They're probably over 6 today in many markets and may go higher. Also understand the assumptions, right? Rents, expenses, understand insurance. Insurance has gotten a lot more expensive. So there's the blocking and tackling, which for you will be very easy to understand. The second thing I would tell you, and frankly, anybody else watching this, is it's time to network. And I would be networking with commercial banks, like local, in your case, Sacramento banks with two or three branches. Because I went to a bank in Fresno that has one of my loans. Actually, I think they have 2 of my loans. Community Bank, I think they have 5 branches. We do our yearly financial review. We bring our statement, our tax returns, our balance sheet. We sit down, have the conversation. He goes, "Okay, great. Thank you. You pass or approve or whatever." He said, "Hey, you got a few more minutes?" And he showed me a manila folder on his desk and said, "We have to get out of 50% of our multifamily loans. We are over rotated to that part of the market. So there's going to be 50% of their loan book over the next 12 months that don't get refied. So that's going to be an opportunity. So there will be bad operators. There will be this, there will be that. So I would get to know local banks, credit unions, and I'd open files with them. I'd tell them who you are, what you do, your background. Let them know you're looking. Let them know your buy box. I want to buy 8 to 20. Here's my financial statement. And what you're looking for, and again, this happened to me. I had a bank president call me out of the blue last cycle and say, hey, I see you doing what you're doing to the building next door. Do you want to buy mine? And I'm like, am I being punked? I mean, like, what's going on here? So that's something I'm trying to do today is ratchet up my name inside commercial institutions. So I would tell you and others to do the same thing. But I do want to close with kind of where I started. Bigger isn't always better. If you're making hay in single families or duplexes, you don't have to go up. It is different though. So I'll stop there and let you ask some questions.
Yeah, I was going to say, let me poke some holes in it because I think I'm the type of guy that knows that I don't know everything. And so as much as I think like, oh, well, it's similar in this way. And so, you know, I have experience in this market with this asset class, you know, and you can tell me what I should look out for and differences. One thing that, you know, just looking at it, and I agree with you 1,000%, just like investors should be screaming from the rooftops, going to real estate meetups. I'm looking to do, you know, rehabs in this area. I'm looking for a duplex in this zip code. Like if people don't know, when it comes across their desk or their radar, they're not going to know to call you. And so I've been telling people, especially ones that work in this specific market, you know, Marysville, Yuba City's about an hour from me. It's probably, you know, similar in price, but a smaller market than Fresno.
Okay.
And I've got 2 fourplexes there. And so I think my assumption, and you can tell me if this is correct, that in a lot of ways, an 8, 10, 12 unit is going to behave, you know, as far as tenant demographics and rents and expenses, similar in a lot of ways to, you know, if I've got a 4 that's all 1-1s, and then I buy a 10 unit that's, you know, maybe 6 1-1s and 4 2-1s.
Sure.
I can expect the rents to be similar. I can expect the tenant demographic to be relatively similar.
You'd be shocked. You know, once you get to kind of 10 units and above, the headache factor really goes up. Parking, parties, alcohol, whatever.
I guess there's more numbers that can cause more conflicts of personality in that, you know, because I see that in 4 units, and maybe it's like, instead of 1 conflict that needs to be resolved a year, it's 3 because it's
exactly, it's
more people
it's not linear, right? If you're familiar with houses and then you go get a 4plex, you're going to go, oh my God, this is a headache. Going from 4 to 10 is the same jump, if not worse. Going from 10 to 20 is the same jump. Just the more people and more defined space, the headaches go up and turnover goes up. Like houses, least turnover. 4plexes, a little bit more turnover. 10plexes, more turnover. 20 units, more turnover. Everybody wants to get to that, hey, my backyard, my space, my parking, my stuff. So
yeah. Let me ask you something too that's like, I don't necessarily know the answer to this, so I'd be interested because you've got, you know, buildings that you finance, so you know a little bit about the lending side of it. My thought is that, like you said, banks are saying we're not refinancing half of these. So there's going to be, you know, newer investors that got themselves in trouble because they didn't know what they didn't know. I also think in a lot of markets that size, 8, 10, 12 units, there's going to be mom and pops that,
oh yeah, for sure,
they're renting their 1-1s for $650. I'm getting $1,100 for my 1-1s. Yep. You know, they're rehab, they're nice, they're well kept. I'm an active, you know, owner, and I've got active managers making it a nice place to live. And so there's some value add in that sense where I can just operate it at a higher level. But with the financing piece, I'm always curious if I look at it and I go, okay, I can increase rents by $300 on 10 units, $3,000 a month, $36,000 a year. This thing is going to look different from a financial perspective once, you know, that kind of turnaround has taken place. But I know they're looking at trailing 12s, like the financing. Correct. the piece of it is like, hey, we're only going to take you to 65% because look at this $1.2 million building. It's only generating X in revenue. So I guess what are the ways, if there is any, to get around, you know, knowing your numbers and knowing you're going to increase that NOI.
Yeah.
But
I guess what I would do in a situation, let's just say mom and pop are renting their units for 60% of market rent in California. Let's be clear. One of the things, you know, but we'll say for the audience, is we have rent control. So you're capped at what you can raise rents. So if you're 40% behind market and you're capped at 10%, which is inflation plus 5%, capped at 10, you could theoretically be years behind.
Yeah.
So you are going to be capped at existing rents, or twirling 6 or twirling 12. What I would do in a situation like that is I would get the seller to take back a second. The second could be just a balloon, like, hey, you know, this building needs work, this building needs love. I'm going to give you your price, but you got to give me 4 years or 5 years to increase value, and I'll pay it off. And what I mean by that is, let's just say you're going to buy it for $1 million. The bank will loan you 600. What you could do is get the seller to take back 200, no payments, a balloon in 5 years. That gives you 5 years to increase value and refi them out. I like that. I've done that a couple times. Others, they're going to want payments. Well, okay, you're going to get payments, but at 1% or something like that, because it all goes to, you know, you have to be able to hold the building for the length of the term. So in a mom and pop situation, I would definitely, at minimum, if they won't be the first, I would try to get them to be part of the second, is what I would look for.
Okay. And then with commercial financing, because again, I don't know, like I can tell you residential financing all day, that combined loan to value, having
LTV,
having the sellers hold that second, is there's going to be limits on that, you know. Easy example, the $1 million building, bank does 6, owner's willing to do 2. They're not concerned with that 80% combined loan to value.
Depend if there's payments. So every bank will have a CLTV cap. I've seen them most be at 80, some at 75, but they will do CLTVs, loans. They will do seconds, because again, they want to be in first position.
Yeah.
But yeah, they won't do 100% CLTV. They won't do 90 today. They probably won't do 85. Historically, they've done 80. Some will do 75. But yeah, CLTV loans or steel structures are pretty common in commercial.
All right. If you got any listeners, Marysville, Yuba City, 8 to 20 units, bring them my way.
There you go. Reach out to Matt, the mortgage guy. Thank you for doing this. I got to jump. Matt, you've been amazing. How can people reach out to you?
If you're looking to get yourself pre-approved for residential stuff, I'm happy to help on the 1 to 4 units. The 1 to 4 units, greatmortgagebroker.com. We're in 47 states. Nevada is coming soon. You know, Nevada, New York, and one other is the only ones missing, but greatmortgagebroker.com. Fill out that form. We'll be in touch. Thanks, Mike.
You got it.